Well, we're back! Hard to believe, I know, but we are indeed back. After so many months away, we are back in the wonderful world of podcasting. This is Chris Versacci, Chief Investment Officer of Tematica Research. We used to do a podcast called Power Talk, where I would sit back and talk with CEOs and all sorts of movers and shakers. But, we're back as Tematica Research, looking at the world through a thematic lens, and we're doing things a little differently. I really suggest you check out tematicaresearch.com. We've got all sorts of stuff going on over there. Everything from weekly thematic signals that give you the latest data points and, yes, signals for what's going on in the investing world from a thematic perspective. We've got the Monday morning kickoff. That's our weekly primer that wraps up the last week and points out everything you need to know, whether it's about the economy, investing, earnings, what's going on the global macro scale, and all of that for the investing week ahead. And as one person once said to me, she goes, I love it. I just love knowing that someone is on the wall every weekend watching out for me and letting me know what's going on. So like I said, we're big back, and better than ever. And it's not just me. We've got a super co-host with me, person I wrote the book Cocktail Investing with. We've done all sorts of stuff. That is one, Lenore L. Hawkins, as I call her, the high priestess of global macroeconomics.
Hey, so we got a lot to talk about today. Lots going on. We just hit 20K on the Dow yesterday. Big day, very big day. And all that because, woohoo, Trump trade. And so everybody's very excited because Trump has come to save the day. I hear next week he'll be walking on water.
That's right. But before we get to that, just real quick, somebody might be asking, hey, Lenore, why did you guys rebrand the podcast going from, Power Talk, which is a pretty cool name, but to Cocktail Investing? And I would say the whole idea here is, and you know this better than anybody, Lenore, that there is so much noise going on today, whether it's, the media, getting all these notifications on your devices, tweets, presidential tweets, and all that there is just so much noise. And what we aim to do is to distill all that noise into clear investment signals for better returns. And I know it sounds like a perfect book jacket cover, right? But the good thing is, we already wrote that book. So check it out on Amazon. It's Cocktail Investing. Pick it up at a bookstore if you can find one, all that good stuff. Or just simply do what we do. Download it, read it on your Kindle, iPad, whatever. So, all right, Hawkins, what do you say? Let's get going. As I like to say this, we're just getting started. So let's go. Dow 20K, what do you think?
Not surprised. Now, what does it mean? Well, it just means there's more and more euphoria in the market. So these days, the market is expecting absolute perfection. And it's kind of interesting to see the level of enthusiasm for what Trump is going to accomplish, which is really what's driven this. Because on the one hand, all the various kind of sentiment-oriented surveys, about 80% of those have been coming in above expectation. But if you look at the real data, the stuff that tells us what's really going on, not what the people think is going on,
Well, wait. Would you mean like actual rail car loading data, truck tonnage, that kind of stuff? You mean that stuff that is all about the real economy, not the hope economy?
Yep, the real economy, about 50% of those, they've come in below expectations. You've been hearing a lot about how great car sales are doing. Yeah, how many people are mentioning that we had a record level of incentives? The dealers are doing whatever they can to get those cars off. And on top of that, with all this talk about housing, woohoo, housing supposedly doing so great, housing prices, except for that's all based on incredibly low inventory. Inventory in housing now is back to where it was in 1999. And one of the reasons for that, regulation. Too damn hard to crack the ground and get started on.
Wait. But Trump is going to fix that, isn't he? Right? He's going to roll back regulation.
Oh, he's going to roll back regulation. He's going to cut taxes. And, oh, yes, he's going to build that wall. Well, when you look over history, usually presidents get about 60% of what they expect to get done, what their campaign promises are all about. Only about 60% of that stuff comes to fruition. And on top of that, Trump is facing, well, shall we say, some rather unique hurdles. Now, normally when a president comes into power for the first time, they've got a fairly high approval rating. Trump's is the lowest approval rating we've ever seen in history. And as we also saw during the primaries, it's not like he gets along all that well with his fellow Republicans. So he's got a lot more challenges facing him to try and get these things through, yet the market is pricing that they're already a done deal, that it's a fait accompli. So what happens if it doesn't actually come to fruition in time before the market loses its patience?
It sounds to me like you're saying buy the rumor, sell the news is what it sounds like.
I'm saying be very, very careful right now. We have priced in a hell of a lot of perfection. If you look at valuations from all kinds of perspective, if you look at price to sales, if you look at just EBITDA to sales, if you look at one of the ones I like to look at because it kind of takes out a lot of the short-term noise, the Schiller's 10-year, his price to earnings ratio, that thing is also at record levels. So across the board, we're pricing in that things are going to be freaking fantastic. Earnings are going to go through the roof. Oh, but wait, what's that other thing Trump was talking about? A strong dollar.
Yep, that's right. That's right.
And we've got Yellen. Yellen knows she is a lame duck.
Well, but it's not just her though. I mean, just look back over the recent, we've got only 25% of the S&P 500 companies that have reported. So a lot to come. But one of the things we've been hearing a lot about is this stronger dollar. As back in late December with Honeywell, General Electric, more recently Adobe, McCormick and Company. These companies that have big international exposure, it's going to hit them. And I think they're going to either, report earnings that are just slightly below expectations and probably offer a cautious outlook. That's what I think is going to happen. But let's bring it back to Dow 20K, right? So you hear a lot of euphoria about it. You see the guys on the floor of the stock exchange wearing those hats, 20K, 20K. I sit back and I go, wow, kind of like a waist size. As I get older, this is how I think about waist sizes. It's just a number. It doesn't really mean anything. And I think the point that you were making, though, about, hey, at 20K, what's the valuation equivalent, and potentially what are those expectations that are out there? To me, there is this gap that needs to be closed, expectations and reality. And kind of like a little kid on Christmas who doesn't get that present they want, there could be some sour faces if it doesn't all go according to plan.
And the plan is absolute Goldilocks, sunshine, and roses. And where you've got...
Whoa. What about unicorns? I didn't hear unicorns in that.
Rainbows and unicorns all over the place. Those are famous on Wall Street.
Right. But let me ask you this, though, too. So the other thing that we didn't talk about yet that kind of has me a little, not spooked, but it is a little unsettling. It's this speed with which we hit 20K. I mean, we did 1,000 points in the Dow in like 42 days, okay? And remember, just to really set the stage, I remember election night sitting there as the numbers were coming in, and the Dow futures, the S&P futures were like falling through the floor. And then all of a sudden, it's like, somebody waved a magic wand. All's right with the world. Cloud pulls away from the moon. There's the moonbeam. Everything is great, hunky-dory. And we've been off to the races ever since. But I just think that as the market continues to climb higher, it gets, stretched and stretched and stretched. And at some point, like a rubber band, it either breaks or it's got to snap back, don't you think?
And the market is looking at this, I think, and a lot of the pundits are looking at this with some very rose-colored glasses. They're trying to talk about, this is going to be just like Reagan. Okay, well, let's assume it is just like Reagan. Well, those first 2 years were hell. Well, right after Reagan won the election, the market rose, but it was right back to where it started by March. And we had 2 years of a very painful recession. And if you looked at where Reagan was with respect to pricing, you had really, really high consumer prices, really high inflation, but you did not have high asset prices. When you looked at the stock market, it was actually priced pretty cheaply. Today, we have low consumer prices, and we have astronomical asset prices, and we have record low interest rates. And the Fed, whereas then the Fed granted Volcker hiked rates, and that's probably what caused a lot of what pushed us into the recession for the first 2 years. But after that, we began the long-term bull market run in bonds. Today, we're at the end, most likely, of that bull run. We could see interest rates go a little bit lower, but it's very difficult to say that interest rates are going to materially continue to move lower from where we are today, because we've got a Fed who says we definitely want to do 3 hikes just this year. And given that Yellen's a lame duck, she knows that Trump's not her biggest fan. It's not like she's going to be pressured to get along.
Well, the funny thing, you mentioned Yellen, is I read this last week. She was saying how, we don't want the U.S. economy to overheat. And I almost fell out of my chair laughing at that statement. Because, you look at that third quarter GDP print, the final one,
That's overheating.
Yeah. Well, that's 3.8% or so. That's overheating. But all the expectations for the current, not the now current quarter, but the fourth quarter of 2016 have it falling. Right?
Yeah.
And
apparently tepid is the new sauna.
Right. And it sounds like, at least based on what everybody's expecting thus far, the first half of the year is going to be somewhere between 2.2 and 2.4%. And I think that's going to be a wake-up call to folks, because we know that there tends to be a lag with monetary policy. There also tends to be a lag with any policy that Trump might put forth, right? It's not like, he gets up there, snaps his fingers, there's the wall, baby, right? It's going to take time, and certain things, even though he's signing a bunch of executive orders, that doesn't necessarily clear the path 100%.
Yeah.
Things still have to be worked out.
Executive orders are not going to get through a new corporate tax rate. And there's already hefty debate over how that's going to be put through. It does not put through new personal income tax code. That's going to take a lot of legislative discussion, and already they're having to, and that's normal too. I mean, when you look back to when Bush, when Clinton, when Reagan, when they commanded the House and the Senate, it wasn't like things went so smoothly then either. And for Trump, he needs to convince 8 Democrats to come across the aisle to avoid a filibuster.
Right. But
how likely do we think that is?
Well, considering they didn't show up for the inauguration, I'm saying probably not very likely. But what was I going to say? That point you just made, though, about tax policy, at least I think they're trying to be smart, right? Where instead of doing one massive tax overhaul, Steve Moore was talking about how they really want to split it apart. Because I think that's smart, because I think people will get on board for corporate tax reform. And if you want jobs, got to lower the tax rate, attract companies. Pretty simple. But we all know that the personal income tax it's going to be a dogfight to get that top tier rate down because of, tax the rich, whoever they are.
Yeah, that one's going to be a much more difficult one to get through, particularly if Trump is hell bent on all this fiscal spending. So you've got this really weird dynamic where we're talking about, the economy is going to get going like gangbusters. And the economy is going to get going like gangbusters because, we're going to do infrastructure spending. And that infrastructure spending means that we're going to have all these construction jobs, except for, wait a minute, if you go and look at the construction sector, there's all kinds of complaints that they can't get skilled labor there now. So exactly where are all these labor going to come from when we do this infrastructure spending? And that infrastructure spending bill has to actually get through Congress, which we'll see how well that goes. And even if we do get those tax cuts increase demand. And if we get them for corporate and we get them from personal income, then that just increases demand. What are they going to want to buy? More products and services. Except for we're going to erect trade barriers. And those trade barriers, what do? They increase the strength of the dollar because they mean less money goes out of the country, more money stays in the country, and that means there's more money outside the country looking for U.S. dollars, which makes the U.S. dollar more expensive. And there we go with corporate earnings.
And folks, that's why she's the high priestess of global macroeconomics. That's all I have to say about that. But so let's just put this together because there's a bunch of other stuff we want to talk about this morning. So I think we can agree that our view is the market has been strong. 20K, okay, it's an interesting number. There's a lot of headwinds out there. The economy may or may not take off. There's still the Trump uncertainty, let's call it. We're still getting more earnings coming in, right? And we'll see exactly what all that means. The Fed, Yellen, once ever the cheerleader for the economy. We'll see if the Fed can really do that and boost interest rates 3 times this year, which, to your point, only strengthen the dollar, roll back, global U.S. growth expectations and corporate earnings, all that. But here's the wrinkle on Dow 20K and higher interest rates that I want to get your opinion on. We both know that over the last couple of years, companies have been rampant in, I call them buybacks. You, on the other hand, call them, I believe it's either Spanx or Wonder Bra.
Wonder Bra.
Yeah, Spanx and
Wonder Bra of corporate finance.
Right. Yeah. So, making things look a lot better than they may really be underneath. So,
fundamentally, nothing's really changed, but it sure looks much better.
Right. I mean, look. That we both know that that's some, we could call it corporate engineering to, hit certain EPS targets. I'm not going to go all conspiracy theory and say that, well, that could be because management bonuses are tied to EPS growth, but whatever. But the point is, with interest rates probably ticking higher and stock prices having catapulted higher, what do you think about the ability to continue to use buybacks in 2017? Do you think we'll still see it, or do you think we might see that pace slow down a little bit?
I think we'll probably see it slow down a bit, but we may see a jump up if we do actually get the Trump deal on the repatriation. Last time we had that in 2004, that's pretty much where that money went, into stock buybacks. And in some ways, it's tough to blame these guys. Yes, there is my comp is tied to my EPS, but we've also got really, really uncomfortable levels of capacity utilization. How much more investment do we really need when we're not using the productive capacity we have today? And for all of Yellen's talk about how we're at maximum employment,
oh, come on. Just stop. Stop. You can't even say that with a straight face, because we all know that unemployment rate is like, it's got more holes than Swiss cheese. Oh. And if we look at any other indicator, payroll to population, labor force participation ratio, it tells a very, very different story. So I go, a very wise person once said to me, the Fed will always be a cheerleader for the economy because they have to. Right? Imagine what happens if, pick your Fed chair, former Ben Bernanke, lame duck Janet Yellen or whatever, if they start getting all, I don't know,
self-fulfilling prophecy.
Exactly. So, I mean, I think the Fed's going to be, personally, I think the Fed's going to be a little more data dependent, just like they've been over the last 2 years. And I'm realizing that I'm about to set you up on a little rant. But we know that over the last 18 months, there have been factors outside the U.S. that have kind of held the Fed's hand in check, right? Last summer, Brexit, what may happen, what may not happen. Before that, Greece and that whole kit caboodle debacle. But we've got some other things on the horizon, Frexit, it'll leave. But we've also got Brexit coming back, and wouldn't you know it, Greece is about to be back in the headlines come February. What do you think?
This is the land of the kick the can. That's what we really do. Greece hasn't been solved. Italy hasn't been solved. All we keep doing whenever we have a problem with debt, everybody stresses out, runs around, yelling and screaming, pulling their hair out, and then, suddenly, miraculously, somebody decides the solution, more debt. And all that does is buy time. But if you're a politician, fair enough, because your interest really is just to the next election and get reelected. Why would you actually solve any long-term problems, which is kind of the fundamental problem we've got with all these nations? And when we look at that growth on a global basis, you look at how much debt has increased since the financial crisis. And that is a huge headwind to growth for everyone. For example, the United States, when Reagan took over, our debt to GDP was under 50%. And today it's over 100% debt to GDP. Now, why would that matter? Well, that matters because all of that debt, not all of it, but over time, that debt has to roll over. So you need to refinance it again and again. It's kind of like having an adjustable rate mortgage, where every, say, 3, 4, 5 years, you need to take some portion of your mortgage and you need to refinance it. Well, if interest rates are going up, then that means the amount of money that you take home every year, more of it has to go to paying your mortgage. And that's what we've got on a global basis. As interest rates go up, which they're looking to do, then more and more of your money goes to paying that debt. Well, that means that money isn't going to spending. It isn't going to growing the economy. It's just going to pay off the overconsumption from years past. So while, yes, interest rates are going up, there's also a big ceiling on interest rates because all of that debt means growth can't get going that fast.
Yeah. I mean, I liken those conversations when I teach to having people think about their credit card statement and their credit card bill. Right? If you rack it up all the way, that's a lot of interest you're paying every month. And God forbid there's a little blip. What happens? You trip the old interest rate bomb, and all of a sudden it just gets worse and worse and worse. But just getting back to Greece for a second, in particular, right? And you, in your writings, you've pointed out that we have a lot of elections coming up in the Eurozone, right? It seems to me that for Greece has to get some deal done before those elections take place. And if they don't, it's a whole nother, big, unknown bomb, if you will, because we don't know who's going to be, in power over there in the various countries. We don't know what their appetite might be, or at least we don't, us here in the U.S. You people over there, in Europe, you might know. And I'm saying that to you, Lenore, because people may not know it, but you're stationed over there for like 70% of your time or something like that, which is great because it gives you a great inside view, which is why I'm going to ask you this question, is what do you think the odds are that Greece gets a deal done before all those elections?
I think it's getting tougher and tougher. I think this time around is going to be a lot more difficult because still nothing's changed. Nothing is going to change. I mean, when you look at history, Greece has been in default roughly half of the time. So it's not like this is a nation that knows how to clean up its mess. And to be fair, the problem that they've got, and it's a similar problem that you see through a lot of Europe, and it's what the U.S. is starting to face now. When you, year after year, you add more and more regulation, more and more rules, more and more controls on everything, it just gets really, really hard for anybody to get anything done. It makes it very difficult to start a business because you got to go here and get somebody to stamp a piece of paper. You got to go there and you got to get somebody to give you a permit. You got to go over here and ask, oh, wait, but you can't actually sell coffee and books in the same building. They literally have that in Greece. How crazy is that?
Well, it's a good thing that Barnes & Noble is having such a tough time. It might curb back their international expansion plans for that because it doesn't sound like it would work over there.
When you do that, it makes it more difficult for businesses to start. But then on the other end, so you look at that and it's become very clear all over Europe that one of the biggest challenges that everybody's facing is there's too many rules. It's too damn hard to get started. So, okay, we all agree on that. Except how the hell are you going to fix it? Who starts? Like, who's actually going to take the political risk to pick a particular area and start getting rid of the rules and regulation? Because there's a reason for all those rules and regulation. It's all the lobbyists, just like you have in the U.S., except for these lobbyists are often like, say, unions. You've got the union of coffee shops. You've got the union of bookshops in Greece, and they wanted protection. And year after year, all these layers of protection build up, and there you have it. It gets too damn hard to start a business, but nobody's going to take the risk to actually fix it. So Greece, they need to get something done. I think it's going to be more and more difficult, and I think it's going to be a lot harder for actually those in power in Europe right now because a lot of that's landing on Merkel's shoulders. Merkel doesn't have a lot of political capacity right now. She does not have the capital. Merkel is facing most likely not getting reelected. So how is she going to strong arm anybody? And on top of that, she used to have the U.S. kind of working with her a little bit. Well, Trump seems to have her as one of his favorite punchlines. So she's not going to be getting much help from him either.
It sounds to me like that's another, I won't call it unknown because it doesn't sound all that, it sounds like it's going to be another speed bump that the market is going to have to endure in the next couple of months. So, I mean, as we look at it, we've got, again, the Trump policy issues or unknowns, which maybe we'll get more color on over the next couple of weeks. We've got earnings to get through, expectations for 2017, 12% earnings growth, the richest we've seen in some time in an economy that, is tepid, I think you said, is what tepid is the new
sauna.
Yeah. So we have that.
And that in the face of rising interest rates.
Right, rising,
and
strengthening
dollar.
Right, exactly that. And then we layer in some of the Eurozone uncertainty, whether it's Greece or Brexit. And it just sounds like...
Elections in France, elections in Germany.
Right, and the market trading, north of 19 times, trailing earnings. So it's a lot of headwinds. But having said that, there tend to be opportunities out there, and I think when we look at the world through our lens at Tematica, right, we tend to look very thematic based. So we don't look at sectors or things like that. We do see these pronounced shifts in consumer behavior, technology, and demographics that are powering things. Very strong tailwinds. And I know, like, one example, it's everybody's favorite company, mine, yours, because they keep doing more and more and more. But it's Amazon, and there is no slowdown in this shift, towards online shopping, mobile shopping, but also too, we look now at where advertising is going. We're seeing it accelerating toward digital and mobile, away even from broadcast. This is the first year that online and mobile advertising, will eclipse broadcast advertising. It's never been like that before. And with, Google and Facebook, embracing video, whether it's through YouTube or Facebook's, platforms, they're going to continue to monetize. So the point I think I'm trying to get at is, yes, we do see some headwinds for the overall market ahead of us, but there's still opportunities out there that are being pushed by these strong thematic tailwinds.
Absolutely. And one of the things to look at when we're looking at the Trump rally is, what are those industries that are going to be protected by Trump? Those will be the places you'll want to put money.
So we're talking defense, construction. And when we talk construction, it's just not the building building companies like Granite Construction. You want to look at the materials, the aggregates. You said a long time ago, oh boy, cement. Cement's going to be huge. And, if we look at like Cemex and some of the others, they've had very, very strong returns on their stock prices and stuff. And any other sectors?
Yeah, well, when you were talking about defense, when you look at defense, there's also going to be demand, not only because Trump wants to increase the U.S.'s defensive capacity, but he's also making quite a fuss about us getting out of a lot of our military alliances, or at least contributing a hell of a lot less. And that means that other nations are going to have to or at least they're going to think they need to beef up their military an awful lot to make up for the support they're not going to get from the U.S. And that means increased demand from all over the world. Right.
So that's probably a good tailwind for Northrop Grumman, General Dynamics, Lockheed Martin, Boeing, exactly, and all those other guys. Okay. All right. Fair enough. So the next couple of weeks, more earnings and, some of that stuff hopefully getting cleared up. But we've also got two other things coming up. We're about to enter the Chinese Lunar New Year. Right, where biggest gift-giving holiday, and in some of my readings, I was kind of surprised that more and more folks are actually leaving China than they will be sticking around in China, which is a boon for air travel. What did I see here? Yeah, more than 414 million Chinese will ride in planes and trains. As if everyone in the year, it's this Lunar New Year. And here's the part that's great. It's as if everyone in the European Union was on the move. I mean, think about that.
And there you go back to sort of those defense stocks as well, because a lot of those guys, like the Boeing, they're manufacturing airplanes.
Right. So it's huge demand, not only for new aircraft, but also retrofitting existing aircraft. I think that's one of the reasons why Rockwell Collins took out BE Aerospace. But from a thematic perspective, what are we seeing over there? We're seeing rising disposable incomes. We've seen that impact how people in the emerging markets eat, trading up from rice-based diets to protein-based diets. And we're seeing it now, where as they embrace maybe the YOLO or the FOMO, fear of missing out mentality, it's I want to see the world, I want to travel. So I mean that's huge, not just for aircraft manufacturers, but airlines, online booking services, and and the like, hotel stocks potentially. So there's a huge area to explore on that. But soon after Chinese New Year settles, those 7 days, we've got probably another American holiday or pseudo holiday here in the U.S., something that you probably know as the Super Bowl. And we're going to talk about it. We're going to talk about it.
No, we're not. We just can't talk about it. We cannot talk about this.
We're going to talk about it for a couple of reasons. One is, Atlanta Falcons, New England Patriots. I mean, you got to love Tom Brady. Tom Brady, his Under Armour jammies aside, and his crazy diet aside, the guy is a machine, right? So
respect for the skills. Not so much respect on the NFL these days, as those guys decided to take my team, after having been in San Diego for over 50 years, they decide that Los Angeles, which in the past has not been able to support just one team, they move 2 teams to the city in the matter of 1 year. I'm sure this is going to go really well.
Yeah, exactly. But let's remember, though, you can't.
No bitterness.
Yeah. Here, think of it this way. They're doing you a favor, right? At some point, all that San Diego's Chargers stuff is going to be collectibles. It'll be worth more later than it is now. But to be fair about that point about the NFL, you have to remember the family behind the Chargers. They could have built a new stadium. They could have done some things.
Oh, yeah.
Instead, they took.
Trust me, they're not going out much these days in San Diego.
No.
Not a lot of love.
No, instead they took the bailout, I guess, and they said, "All right, we're moving on. But
although word is that the NFL owners are already starting to say, "Hey, maybe you guys ought to go back to San Diego."
Well,
Whoops.
so let's think about some other angles about the Super Bowl, and
You mean the guilty pleasure?
Oh yes, the guilty pleasure, the beer, the booze, the chicken wings, the chips, all that stuff. And, again, just
Pepto.
Maybe. We read a lot, and we're constantly looking for all sorts of data points and stuff. And I could not believe the one that I saw. So from a thematic perspective, this ties together what we call guilty pleasure, disruptive technologies, and connected society. And when I tell you what it is, you're not going to believe it. Okay. All of that comes to you in a bag of Tostitos.
It's unreal.
Isn't that amazing? So
It's just seriously unreal.
So
Chris, tell them what this bag does. This thing is unreal. I'm not sure if I like this or I feel sort of offended. I mean, I kind of feel like I'm going to be judged by my bag of Doritos.
So I kind of have to read this a little bit. So it's a bag of chips that comes with a sensor, and that sensor is connected to a controller that if you breathe on near the bag, it's going to tell you what you're blowing in terms of alcohol content in your breath. So, if the sensor turns red and flashes an image of a steering wheel and an Uber code, can you imagine that? An Uber code. And my understanding is that it's going to go one step further, and it might actually bring the Uber to you, which probably means, if that's right, there's got to be some GPS capability in that little doohickey that they stuffed inside your chips.
I really feel judged by my Tostitos at this point.
Lenore, off the booze.
What if I'm staying home? I may not be going anywhere. Why judge?
Well, what you do then is for the people who are over, you give them the Tostitos bag to hold.
Yeah. Stay away from don't breathe. Whatever you do, don't breathe on the Tostitos. This takes double dipping fear to a whole nother level.
It's like, I don't know if I should double booze. The Tostito bag is right next to me. Watch the bag. Well, I'll tell you what, though. The other thing that's pretty cool that Kraft Heinz is doing, aside from this Tostitos bag, is they are doing something that I think everybody watching the Super Bowl says every year, why don't they do this? And Kraft is actually doing it. They're giving all their salaried U.S. employees the day off following the Super Bowl. How great is that?
That's pretty cool. That is really cool. That should get them an awful lot of attention. That should be a fantastic spend as far as marketing goes.
Well, it's funny you say that, right? So, what's the average 30-second spot in the Super Bowl go for this year? $5 million for 30 seconds.
Well, I mean, let's be honest. That's kind of what you watch it for these days. I mean, the last couple of Super Bowls have been painful to watch.
That's true. But the last year or so, there haven't been any standout commercials either.
No, there haven't been. Creativity, not so good.
No. I mean,
come on, guys, step it up.
Cheetos had some good ones in the past, but thank God Budweiser has killed those frogs off, because I could not stomach any more Budweiser frogs. So anyway, all right. Any parting thoughts, Lenore?
Stay away from the Tostitos after the margarita.
Certainly yes. And well, that's why they call it cocktail investing, Lenore.
Yes, they do.
Yes, they do. All right, so we're wrapping up today. We'll be back, next week with more distilling, more noise, trying to get you clear investment signals, putting it all together, the market, the economy, and some other fun cultural happenings. So with that, we'll take adieu and catch you next week.